Inflation is a tax, and it's really the most brutal form of taxation when you think about it, because it's not only is it surreptitious, it's hidden, but it's a regressive tax. The people who control this world claim to care most about the poor, but if you think about food and energy, the poor pay the greatest percentage of their income on clothing, food, and energy, the things most affected by inflation.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for July 24th through July 31st, 2023, while supplies last. And on this one, supplies may not last long, because this week we feature 2023 American Silver Eagles at just $6.99 over spot, our lowest price on Silver Eagles in more than a year. Since its first release almost 40 years ago, the Silver Eagle has been, without exception, the world's most popular bullion coin, which provides unparalleled recognizability and liquidity. It's 3/9 fine, comes 22 a tube, 500 to a box, and is available at just $6.99 over spot while supplies last. Finally, the Silver Eagle is IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Michael Pento, an active money manager and the founder of Pento Portfolio Strategies, joins us this Thursday, July 27th, 2023. Michael, thanks for coming back on Liberty and Finance.
Always a pleasure, Mr. Dunnigan.
Always a pleasure when I can get the date out correctly, and I appreciate your patience with me on that. And also wanted to get an update from you. You send out these midweek updates. I always call them the midweek sanity check. You call them a midweek reality check. Can you give us an understanding of the people have been watching very closely this week in particular for the Fed's announcement, as they always do, but that may not be the biggest story that you've been following for your leading indicators. Tell us what you are watching now that people should be aware of.
There's a lot of cross currents, Dunnigan, to be honest with you. So we had a GDP figure today that showed that Q2 GDP increased by 2.4%, and that was greeted initially by another, boom in stock prices. The dollar soared. It was a very heavily shorted currency. The dollar just ripped today. It's sending emerging markets down. It sent gold crashing intraday. I don't think that's a very, extended trend that's going to happen, but it's a bad day for me in my portfolio, I'll be honest with you. But back to that GDP report, 2.4%. I just wanted to make a comment about that because, the market seems to be, I've been doing this for 32 years, so I don't say this flippantly. This is not garrulous speech. It just seems to be run by a bunch of monkeys right now, a bunch of day trading monkeys. So, they see this figure, headline figure, 2.4%, the economy expands by an incredible 2.4%. It shows the consumer's healthy and everything is great. And people actually invest on that. At least they did in the short term. This interview is being recorded in the middle of the day. Maybe by the end of the day, the market will be down for all I know. But the S&P was up about 0.8% the last time I looked at it. But I want to just make this comment to you. This is what I call my program the midweek reality check for a reason. So what is GDP? There's basically two components to GDP. It's productivity and labor force growth. Those are the primary ways you can think about growing an economy. How can I grow my economy? I can increase the number of people, the number of hours worked more specifically, and I can make those people more productive. It's GDP, right? That's the essence of C plus G plus I plus or minus net exports. C plus G plus I, of course, is the GDP formula officially from the Bureau of Labor Statistics and Bureau of Economic Analysis, I'm sure. That's the correct bureau. So let's break that down. So the government themselves puts out statistics on those two things that I mentioned. Well, the index of aggregate hours worked is actually down 1/10 from the start of this year all the way through the end of June. 122.5 down to 122.4. So half of GDP, which is labor force growth or hours worked in that labor force, is down on the year, not up, down on the year. Okay, then you say, well, Mr. Pento, maybe it's the economy is becoming massively productive. Well, productivity shrank in Q1. We get it as a quarterly figure. We get it at the end of each quarter, but it actually shrank 2.1% in Q1. So unless there was this tremendous rebound in productivity, which there is no evidence of anywhere in the preliminary data, the actual economy is shrinking on a real basis after inflation. So all we're really measuring here, Dunnigan, is a miscalculation of inflation by about 2 or 3 percentage points. Yes, the government's own data, if you look at productivity and hours worked, shows without a doubt, if measured in real terms, the economy is shrinking. But that doesn't matter. People trade on headline news, and that's what happens. So I'm not really that upset about it. If you want to look longer term, the credit cycle is dissolving. The foreclosures are increasing. There is a delay in the Fed's rate hikes. You know, going back a year ago, Fed funds rate wasn't anywhere near 5.25% to 5.5% where it is today. So they have a delayed reaction of the Fed funds actions. And I think probably at the very latest, the fall or the spring, fall of this year or the spring of 24, we'll start to see some of the manifestations so evident that even the BEA has to acknowledge it.
Manifestations of a slowing economy because of the higher interest rates?
Yes. And also, let's think about quantitative tightening. You know, first of all, let me just tell you, I run money for a living. I just put a midweek reality check. So it's my job to get, you know, people want to make money. At least my clients want to make money. They don't want to tell me a story or have an economic philosophy. Not interested in that. They want to make money. And the good thing about my model, even though it's vastly underperforming the averages this year, vastly blew them away last year, but this year we're underperforming in all candor. We don't have any shorts in the portfolio. We have no short equity positions in the portfolio. And there's a reason for that. The model picked up early this year that we're headed for a disaster, but it's just not time to get net short in the portfolio yet. So we have one component. I'll tell you, it's BTAL. It shorts equities that are low beta, but goes long equities that are shorts equities that are high beta, goes long equities that are low beta. So it's not net short anything. That's why it's not really a short. It's called short volatility ETF. We are also short high yield. But other than that, we have nothing but longs in the portfolio, bonds and equities. And the reason for that is the model understood that what Powell did in March of this year, seems like years ago, doesn't it? But you remember when there's 3 banks that failed, 4 banks so far this year, but there was 3 banks at the time that failed. What did Powell do? He launched something called the Bank Term Funding Program, right? And what did that actually do? He printed in 2 weeks $400 billion. But he didn't just do that. He then guaranteed every single depositor that was eligible for FDIC insurance. So anything under $250,000, every bank account, every named bank account that was under 250 was insured. And then he also did something else. He said, not only did he print this money, but he said, all of you distressed banks, please hand me over, if you so desire, all of your mortgage-backed securities, all of your treasuries, no matter how much underwater they are. I don't care what they're priced at. And I will give you money at par, full value for a year. Think about that. Think about what he did. And perhaps that's what is extending and protracting this decline in the stock market and in the economy. It's holding in abeyance longer. Of course, there's also the fact that corporations did refinance at a lower rate, not high yield. Investment grade did. They locked in those rates for a longer duration. Homeowners don't have this great reset coming like they had in 2008 of adjustable rate mortgages. But the counterfactual there is, the other side of that coin is that the real estate market is frozen. There's no existing homes for, there's nobody wants to trade their 3% mortgage for a 7% mortgage. So they're not moving. And there's just a very slight tick up in new home sales, but they're only 10% of the market. So in other words, what I'm saying is that the economy is slowing. That is a very protracted process, but we're still headed in the same direction that we were, in my opinion. In my opinion, we're headed for a worse crisis than we were in 2008. It's just taking longer to get there because of the refinancings not happening and of what Mr. Powell did in March.
In your view, this basically it's a kind of a bailout of the banks by saying, send me all your dirty laundry and I'll pay you full price for it. Do you see that? Others have called for some time now for the Fed to step up and be the buyer and lender of last resort, to own it all, to buy it all, that kind of thing. This idea of one bank to rule them all. We've already seen like the flight of capital out of small and regional banks after the series of bank failures you just mentioned. And there's some predicting, including, I guess, Brainard from the advisory to the Fed saying, gee, that's what we should do. We should just have CBDCs and have the Fed handle everything directly with the Treasury. Who needs these banks out there? So do you see this, I would call it a bailout of the banks, as a step towards the Fed being actually taking a bigger role in ownership of real estate, for example?
Well, the Fed is launching as we speak, not per se a Fed coin, but a new way of clearing money, competition to the ACH system. You know that, right? So I think that's the first step. The next step is going to be, so basically this new system is going to have automatic transfers of money 365 days a week, 24/7. So that's the precursor to what I believe is the next big thing, which is the Fed coin being launched. They'll work hand in hand together. And then I think we're in big trouble because, I mean, if you have a chairman who espouses, Fed Chairman Jerome Powell espouses tighter monetary policy, but you see what happened at the first sign of distress. I mean, he did those three things I just mentioned. He did it immediately in 2 weeks. Within 2 weeks, everything was solved, papered over, and it took $400 billion to do it. But he hasn't solved the underlying problem. The underlying problem is a vastly lower rate of change in fiscal and monetary policies. You still have interest rates that have gone from 0 to now 5.25% to 5.5% in a year and a half. That has never happened before. That's the greatest rate of change in the cost of money. And there's a lot of loans that are geared towards the prime lending rate. So the adjustable rate mortgages, credit cards, auto loans. So the consumer is going to be under a lot of stress, and is increasingly going to be the case. It's just going to take more time.
In your model looking forward, what do you have to say, or outside of your model, what do you have to say about the real estate market? A lot of people sitting on homes, they're considering selling, a lot of people trying to find a home, and it got a lot harder in the last year with rates doubling and so on. Can you give us your views on the real estate market, both from buying, selling, and inventory?
Well, I mean, it's no secret. I mean, I'll give you a little anecdotal evidence. The community I live in Naples, Florida, had one resale in the entire community, which is about 1,000 units of homes. One resale the entire year. There's just like I said, there's nobody who wants to trade their 3% mortgage for a 7% mortgage. So the existing home sales market is dead. We looked at pending home sales that came out today. They were down 18% year over year. So the real estate market is dead. Not only is it costing more to get a mortgage, a new mortgage, but home prices haven't come down yet. They really haven't fallen yet. So if home prices, I think they fell for one month, and then they came back up the following month after that. So if home prices aren't really falling and the cost of carrying that mortgage is increasing, there's only one thing that can happen to the real estate market to make it right, and they have to drop by about 30% to bring it back to that, to bring home price to income ratios back to some semblance of normalcy, affordability. They have to drop about 30%.
When you were describing the phenomenon, the two parallel phenomenon of no transactions happening, no sales happening at the same time, rates remaining high and prices remaining high, that sounds like the stagflation. Is that because it's stagnant and it's high prices?
Yeah, and I mean, you saw the CPI. I think that's what you're leading. So you saw the CPI come down from 9% to 3%. But I think now getting to 2%, 3%, by the way, is 50% higher than 2%, the Fed's target. So they're still nowhere near where they want to be. And I think because of base effects and because of what you just mentioned, rent, owner's equivalent rent, and then you throw oil, energy in there, gas prices, I don't see any way that the July reading is going to be better than June. And we're going to get that in August. So what is Powell going to do when he says, geez, I'm way off my target and the core rate and the headline is moving further away from my target? I mean, he's going to have to stay more vigilant, in my opinion. The good news here on this front is that the Fed's balance sheet finally now is going to mean something, because the Fed's balance sheet reached almost $9 trillion before QT began, and then they were draining the balance sheet slowly. They drained it back to $8.3 trillion, but a lot of that was being offset by the emptying of the TGA account. So it was just one hand washing the other. They were taking money out of the system with quantitative tightening and then throwing it back into the system by having the TGA being drained. But that's gone now. Now the TGA is being refilled. It's about $700 billion last time I checked. So I think they don't have much more to go there. So QT is going to be just now pure draining of bank reserves, which is, last time they tried that didn't work out so well. So I see stagflation in the next few months. But by the way, I'm not a stop clock here. I try to keep it real. So I did call for inflation to rise significantly in 21 and 22. Then I said 22 would be a later part of 22 would be a condition of disinflation. And then I called for outright deflation. I still think we're headed for deflation, but the next few months here are going to look a whole heck of a lot like, at least the next month is going to look a whole heck of a lot like stagflation.
What about the stability of the banks? We mentioned a couple of times, you once, me once, that we had this flurry of bank failures and that as you pointed out, was papered over. What's your impression of the stability of the banking system, either here in the U.S. or abroad?
Well, it's in big trouble. That's the nucleus of the problem here. So the banking issue, which was one, especially in the regional banking, which was one of, hey, I cannot pay my depositors anything close to what treasuries are offering. And Powell made that worse by what he did yesterday. So we're 5.5% on the shortest term government debt is 5.5%. Regional bank loans, which primarily 70% of commercial real estate is done by regional bank loan lending. If their assets, which are their loans, are earning them 3%, and they're forced to pay 5.5% to their depositors, well, that's an recipe for bankruptcy and insolvency. So what they've done is they haven't paid their depositors what they earn, which they should earn. That's caused massive deposit flight. And look what happened with PacWest this week too. I mean, the stock was down 27% during the trading day yesterday before it was taken over by Bank of California. It was a very large institution, a very troubled institution, but the problems haven't gone away because you just can't pay depositors what they deserve and they can get in a U.S. Treasury. So that's the nucleus of the problem, but that's the problem today. The problem down the road is going to be these bank assets that we're talking about: commercial real estate loans, mortgage-backed securities, credit card loans, auto loans, CLOs, collateralized loan obligations, all those things which have doubled in size since the global financial crisis, are going to be in deep trouble if I'm correct about the recession coming. And again, the recession's coming. It's going to be very deep. It's going to be a trenchant, brutal recession, in my opinion. It's just been extended and delayed. The process has been extended and delayed. It's being held in abeyance by what the Fed did in March, the TGA being emptied, their reticence to drain the balance sheet faster than what they really should be doing. Don't forget, the Fed's balance sheet going into COVID was $4 trillion, just above $4 trillion. It went almost to $9 trillion, as I said. So that's a huge increase. Think about, printing $5 trillion in the course of a couple of years. Think about that. It's unbelievable. From 1913 to 2020, the Fed's balance sheet, which is base money supply, again, this is physical coins and currencies in existence plus bank reserves, which is the building blocks of all money. It took them all those years just to get to, just to get to 4 trillion. And then it goes to $9 trillion in a matter of 2 years. Hey, do you think you want to own some? I mean, I know gold isn't behaving well today, but given the fact that it's being used more and more as a supplantation of the US dollar, right? There's a lot of countries out there who don't like dollar hegemony. They don't want to be victims of US sanctions. And they'll conduct their trade in commodities and energy and goods in dollars and in gold instead of dollars. That's boosting gold. And then when you think about what's happening down the line, I was just to work this into the conversation, and it's important. I know it's not happening tomorrow, but if you're looking at long-term trends, and a lot of people, I'm sure that you in your audience are long-term holders of gold. By 2040, this is not my opinion. This is the CBO predictions. By 2040, 100% of all of our government revenue is going to go to entitlements and interest on the debt. 100%. 2040 it sounds like it's a long way off, but it really isn't. 17 years isn't all that long. But as you approach that number, the government doesn't function. So it's a massive monetization of debt that has to continually happen. And that means money printing isn't going anywhere, but much, much higher. By the way, the CBO estimates do not include any recessions. And I will tell you that if we can go another 17 years without any recessions, I'll sell hot dogs outside of the New York Stock Exchange. Dirty dogs outside the exchange. How's that?
Michael, whenever we speak with you, it feels like we get an eye-opening, and it doesn't make us feel any better, but I guess at least we're aware of what's coming, and that gives us the chance to do some preparatory steps. If people want to follow your work on a weekly basis, what should they do?
Well, you go to pentoport.com, and you could subscribe to the podcast. You get a 4-week free trial. It's only $50 a year. So if you want to get the real data, real facts to concentrate on, subscribe to that. You get my 36,000 foot view of the world. You also, if you have $100,000 to invest and you're a U.S. citizen, I'll manage your money directly for you. If you want to learn about the hottest AI stock, you're not going to get that here. What you will get is an analysis of the business cycle and my determination of what the second derivative of growth and inflation is going to do. And if you get that right, you'll save yourself from getting destroyed in recessions and market crashes like we did in 2022. And you'll be able to participate in bull markets. I don't think this is a bull market. I still hold very true to my belief that this is a extended and protracted bounce in a bull market. So it's a bear market bounce. I'm sorry, not a bull market. It's a bear market bounce. So a cyclical bull market within a protracted bear market. And you'll see that very clearly, probably at the latest by the fall and spring of 2024. That's what I say.
Well, Yeah, we've got a lot of our subscribers and our viewers that have had that feeling for a long time. That it reminds me. Somebody mentioned this. It reminds me of the movie The Weekend at Bernie's, where you've got people propping up a dead guy just to try to keep passing him off as though he were still alive. And it takes more and more trickery to get that, to pull off that illusion. And so you just mentioned some hijinks that's been going on in the last few months regarding propping up the banks and so on. People feel like we're on a really extended life support here, and that nature isn't being allowed to take its course. Usually when it has to do with how you maintain a forest by not letting nature have periodic fires that clean out the forest, and it just makes the problem worse and worse and worse, the potential problem. Is that what you see happening here financially?
That's a very well way to put it. I mean, what central banks are doing is they're fighting gravity and entropy. Sometimes it's very healthy to burn the underbrush of a forest so you don't have a cataclysmic conflagration, a holocaust in the woods. So the central banks came along and they said, I guess they started really after Alan Greenspan in '87 crash, that it's not, since we have this technology of a printing press, maybe we don't ever need to have a stock market go down, and maybe we never need to have a recession. I mean, I guess it's a good idea. Why would you want people to be unemployed? I mean, the road to hell is paved with good intentions. But look what they've done. I mean, look what they've done to the middle class of this country. If you wanted to buy a house right now and you had to come up with 20%, where are you going to come up with that cash from? The loan, the bank lending they're pulling back their loans, and even if you could qualify for a loan, you're not going to get one because of that fact. But I mean, the average, I don't know what the median home price is off the top of my head, but it's soared. It's up 30%, a third in the last 2 years. In aggregate, and in most parts of the country, not just that's an aggregate. I mean, I'm sure they weren't, in Indiana, they didn't go up. But according to Case-Shiller, they went up 20% year over year in the last 2 years. So it depends on the metric you look at. But just think about that. Did your income go up by 30 or 40% over the past? Not for most people. It just didn't happen. So what we're doing here, I'll leave you with this. Don't mistake inflation for genuine, productive growth or genuine, healthy economy. Don't conflate the two. That's what I think that Wall Street's doing. As before I got on this program, they were conflating a 2.4% headline, beat the number, better than expected GDP print. But again, if you look at the components of GDP, productivity and labor force growth, aggregate hours worked, it clearly shows that the economy is not growing at all. We are just mismeasuring the actual rate of inflation, under calculating it, period.
One more question I forgot to ask you. You were mentioning about what the Fed has done to the middle class, and we've been talking about how they say they're narrowing in on their inflation target, but their inflation target is not zero. And that's something that really sticks in my craw. And some other guests have been on here saying that inflation is theft, and that if the ordinary person understood how it undermines the purchasing power of their earnings and their savings and their retirement, that they'd be up in arms about it. But that most people they understand high prices. They see high prices. They don't realize that the Fed has a target of inflation to keep prices increasing and to keep the money supply increasing. Any thoughts on that?
Well, inflation is a tax, and it's really the most brutal form of taxation when you think about it, because it's not only is it surreptitious, it's hidden, but it's a regressive tax. The people who control this world claim to care most about the poor. But if you think about food and energy, the poor pay the greatest percentage of their income on clothing, food, and energy, the things most affected by inflation. So it's totally incongruent with their diatribe that they claim to care about the poor and the middle class, and then seek to destroy them with an inflation target that they now consistently miscalculate count, undercount, and overshoot.
Well, Michael, it's always very helpful to have you with us and our viewers, and I appreciate it to no end. Always thank you for joining us on Liberty and Finance.
God bless. Take care.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.